It's John, and he writes to us on our YouTube channel. And this was a two-parter, by the way. John wrote a part of this. We kind of made a comment on it, told him we were going to maybe use it on the radio and podcast, Get Ready for the Future show, and then he came back with another one. So we're going to have a two-parter, so stay with us on this one. When I'm ready to retire, I heard a rumor that if I have enough savings to live on for a couple of years and lessen my hours substantially, putting me in a different tax bracket. When I retire and pull out my 401k, it will be taxed in my new tax bracket. All right, that's the first part. Second part, to piggyback on that, supplemental money like profit, dividends, T-bills, or rental income is applied as income as well. Trying to plan for later down the road since I get taxed a lot right now. John, thanks very much.
Before we get too deep into this, I do want to clarify one thing, and I don't know what John's intention was, but he said when I pull out of my 401k at retirement, you don't have to just liquidate your 401k when you retire. You can transfer it to an IRA instead. That way it protects the tax status, so you're not paying for that. There have been a number of people that have over the years thought they had to just liquidate the whole thing. Mm-hmm. You don't have to do that. You can transfer it to an IRA and then create an income stream from it. So wanted to throw that out there before we got too far into it.
Yeah, and we do also want to throw out to John, which we told him this on YouTube too, we're not CPAs and we are not giving you tax advice. We can just talk about the general rules of taxes when it comes to retirement income. And that's what John's really talking about. All of that, very complicated, a lot of things going there for John, but it is all about retirement income and how it's going to get taxed. And that is very important. He should be focused on that. One of the things I would say first, though, is it's not a rumor. He is correct in the sense that if you assume that your savings that you're going to live on are coming out of your bank account, which means you've deposited the savings there after they have been taxed through your payroll, right? Okay, That's the assumption I'm going to make, is you're using cash savings to live on for a couple of years, and you're going to reduce your hours. So if you did an apples-to-apples comparison, let's say you make $100,000 a year, and right now you're making all of that from employment income, and you're talking about reducing to, let's say, $40,000 from employment, but you're going to replace the other $60,000 with bank savings, then yes, you only have $40,000 of taxable income, of earned income for that tax year, as opposed to the 100 you had the year before. So it could make a difference in your tax bracket. And then if you're going to add in 401k, that is going to be taxed at ordinary income tax rates, whether it's in an IRA, as Teresa said, or a 401k. Doesn't make any difference, but it's not taxed until you pull it out, not when you roll it to an IRA if you chose to do that. So not to get too complicated through getting all the particulars of this, but generally that is true. You would be potentially in a lower tax bracket if you used cash savings to supplement your retirement income as opposed to employment income.
But the question would be, what happens when those savings are depleted?
Yeah.
Because they're not going to last forever. Even if you save 2 years worth, great, that's fantastic. But what next?
Right.
That's why it's so important that you think about the different factors. So anything that you pull from your 401k, if it's all pre-tax, because some do offer Roth,
right.
But if it is pre-tax, it's going to be taxable no matter when you take it out. And your taxes are based on how much income you have in a given year. So you might be able to buy yourself sometime that first couple of years of lower taxation, but it's not going to sustain because you're going to have this taxable income later.
Yeah. And if you're going to live on less income in retirement, then this might be a good way to phase out to that, right? To get out of that higher tax bracket. But if you're still planning on replacing your income and living on what you made when you work, then you got to have a long-term strategy, to Teresa's point, because your cash savings are not going to bridge the gap for long. So you're going to have a plan to pull that out. And unfortunately, you're not going to be able to get around the taxes, right? You can't avoid it, and no matter what anybody says to you on the air or otherwise, you can't avoid paying taxes on dollars that have not previously been taxed. What you can do to prepare, potentially, and I'll be honest, not a lot of people take advantage of this, but you can do some Roth conversions, especially in those early years of retirement. If you're living on less income, it might be less tax to pay than it is when you're living on a higher income. And basically that's to take your 401k, let's say you roll it over to an IRA, or even potentially left it in the 401k, to convert it, if the option is there, to a Roth, which it would be in a traditional IRA, and pay the tax dollars on the amount that you convert in the year that you convert them. So you still have to pay the taxes. Again, not avoiding the taxes, but then you've set up a tax-free income stream in retirement. And we have software that will help you walk through that. We can come in and tell you if it makes sense for you on a tax basis. So that's an option. But a reason I say most people don't take advantage of it is because they have to have the out-of-pocket money. They have to have some of that cash savings to pay that tax.
Because when you do a Roth conversion, the provider does not pay the taxes on your behalf.
Right.
So that means if your taxes were increased by $3,000 or $4,000 or more, you have to have the money to be able to pay that in the year that you do that conversion. So it's really important that you plan for that. And you did talk about, John, in your question about rental income, about dividends. You know, there are passive income options out there, rental income being one of those. But you still have to report that income and pay taxes on it. Right. It's just you might have some things you could write off to balance it out a little bit. With dividends, if you have qualified dividends, then they are taxed depending on your income level, but they're a little tax favored. Whereas ordinary dividends are just based on income for the year. So, you know, it can get a little complicated. So what we would say is it's more important that you have a strategy and a plan that helps you mitigate taxes, plan for taxes, not try to avoid them.
Yeah. And is your plan to minimize the taxes, and is that your priority? Then you can work with that being the lead. But in most cases, you're really what you're looking for here is a specific monthly income, something you can count on. And that really is, from all of these sources, John, I would say we can work a plan where you can have on paper, on purpose, a retirement income monthly. We can estimate the taxes. You'll see the net number when everything is considered, and you'll see that number get bigger on an annual basis. You'll get an annual raise, and that allows you to not really worry about it anymore, right? You can see what's going to come to you on a monthly basis, and that has really been proven also through studies to make retirees feel better if they have a plan to take all of their assets, combine them together, and have a monthly income stream so that they can see that come to them.
And I think I got to see this during COVID. There were a lot of people, knowing what I do for a living, that would say, oh, I bet your clients are just wearing you out. And I had to honestly say, no, they're not, because their month-to-month income is covered. They're not really concerned with the fluctuations in the market because we have a strategy for handling that. And I think that's the difference. And what a lot of people are really looking for, John, is you're looking for a strategy to handle it. It's not avoidable, but if you can create a strategy that gives you a kind of a leg up from just being able to plan ahead for it, then it's not as scary to pay those taxes.
And John, I would finish by encouraging you to give us a call, and anybody else that is wondering about taxes and retirement, how they're all going to work, all the pieces getting into a puzzle, you can give us a call and set up an appointment or just a phone conversation with a Gen Wealth advisor by calling 866-653-PLAN. That's 866-653-7526. And John, we like your question so much, we're going to name it the question of the week. We thank you for reaching out with that, and we're going to send you a free Get Ready for the Future Show tumbler, as seen right here on our video screen if you're watching the video version. You just need to email us and let us know how to get it to you. Send the email to show@getreadyforthefuture.com to claim that mug. Thanks, John.